Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on consolidated statement of profit or loss by looking at a question that involves mid-year acquisition. We have done a lot from the beginning of consolidated financial statement. We've completed a series on consolidated statement of financial position. And then today we are finishing the series on consolidated statement of profit or loss. After which, in the next videos, we are going to combine a question that involves both the financial position and the profit or loss. And then we'll proceed to deal with our accounting for investment in associates and joint ventures as part of the consolidated series. And so we still have a lot to do in consolidated financial statement. But for now, we are going to look at a question, okay, on consolidated profit or loss, which involves mid-year acquisition. Now, we have not dealt with that yet. So we are going to look at a question, a situation where the subsidiary was bought in the middle of the accounting period. You know, for almost or for all that we have done so far, we always assume that the purchase of the organization was done at the beginning of the period of an accounting period. Usually that is the case, but then there are exceptional cases where the acquisition of the subsidiary could be done in the middle of the accounting period, or as the accounting period is already in session, then there is a purchase. When that happens, the way you are going to do the consolidating is going to change. And that is exactly what I'm going to teach you right now. So in this question that we are going to solve, the subsidiary was acquired in the middle of the year, in the middle of the accounting period, meaning that the statement that we are going to consolidate, half of the items on the financial statement were already done, or if their expenses may have been incurred before the acquisition was made, and then the parent continues to hold the subsidiary for the rest of the period. And so we are not going to waste my time. I'm going to read the question to you and I'm going to explain to you as I have always been doing. And then you understand how to consolidate a statement of profit or loss when acquisition was made in the middle of the year. So this is a focus, mid-year acquisition. All right, so let's look at this question briefly. Moon Limited operated as a single company, but in 2025 decided to expand its operations. Moon Limited acquired a 60% interest in Stars on 1st January 2025 for 2 million Ghana cedis. The statement of comprehensive income of Moon Limited and Stars Limited for the year ended 30th of June 2025 are as follows. So just to let you take note that the accounting year ends in June 2025. But then the purchase was made in 1st January or on 1st January 2025. So please take note. So these are two financial statements. Statements of profit or loss for Moon Limited and Stars Limited. You have your currency sign with 3 zeros up for each of them. Revenue 22,800 against 4,300. Cost of sales 13,600, and that of Stars is 2,600. There is gross profit of 9,200 for Moon and 1,700 for Stars. Administrative expenses, you can see 2,900. No, sorry, distribution cost 2,900 against 500. Administrative expenses 1,800 against 300. And then there is finance cost 200 for Moon and then 70 for Stars. And then we have finance income. Finance income is 50 for Moon and there is nothing for Stars, giving us a profit before tax of 4,350 for Moon, 830 for Stars. And then there is income tax expense, 1,300 for Moon, 220 for Stars, giving us profit for the year end at 3,050 for Moon and then 610 for Stars. There is also other comprehensive income for the year net of tax, which is 1,600 for Moon, 180 for Stars. Total comprehensive income for the year, 4,650 for Moon, 790 for Stars. So this is the statement of profit or loss. Now, let's look at the additional information. Since acquisition, Moon purchased 320,000 Ghana cedis of goods from Stars. Of these, 60,000 Ghana cedis remained in inventories at the year end. Stars makes a markup on cost of 20% under the transfer pricing agreement between the two companies. The fair value of the identifiable net assets of Stars on purchase were 200,000 Ghana cedis greater than their book value. The difference relates to properties with remaining useful life of 20 years. Then we continue. On the acquisition date, Moon Limited advanced a loan to Stars Limited amounting to 800,000 Ghana cedis at a preferential interest rate of 5%. The loan is due for repayment in 2032. Statement of changes in equity extract for the two companies. We have for Moon Limited and Stars Limited with 3 currency size. Balance as at 1st July 2024. So the opening balance is 1st July 2024. We have Moon to be 12,750, Stars 2,480. Then there is dividend paid, 900 for Moon, nothing for Stars. Total comprehensive income for the year is added, 4,650 for Moon, 790 for Stars, giving us a closing balance at 30th June 2025 to be 16,500 for Moon, 3,270 for Stars. Moon Limited and Stars Limited had 400,000 Ghana cedis and 150,000 Ghana cedis of share capital in issue throughout the period respectively. Required. Prepare the consolidated statement of profit or loss and statement of changes in equity extract for the Moon Group for the year ended 30th June 2025. No adjustment for impairment losses is necessary in the group financial statement. Assume income and expenses other than intra-group items accrue evenly. All right, so this is a question. All right, so we're going to solve this question together. Now, what I want you to understand is that this is a mid-year acquisition. Okay, looking at the question, we are told that the accounting year ends 30th June. But from the introduction, the acquisition was made on 1st January. So if the accounting year ends for both companies, the accounting year ends in 30th June, and the acquisition was made on 1st January, then it means that the acquisition was made in the middle of the year because it had been 6 months since acquisition. Now, from the opening balance of the changes in equity and even the information that we have, we can see that for these companies, the accounting year begins from 1st July 2024 and is supposed to end 30th June 2025. Okay, so this is the 12-year period, and the acquisition of the subsidiary was made in 1st January 2025. So from the beginning of 2024, 1st July, till the end of that year, which is 31st December, which was supposed to be the first 6 months of the accounting year, there was no acquisition of the subsidiary. Now, when we got to January 2025, we bought the subsidiary Stars Limited. That is from Moon Limited actually purchased the shares in Stars Limited on 1st January 2025. What it means is that, we have already learned that accounting year is not the same as the calendar year. The accounting year is 12 months period, beginning from the date where the business started. So from 1st July to 30th June is 12 months. That is the accounting year we are dealing with. And therefore, if the purchase was made in January, what it means is that the purchase was made in the middle of the accounting year. And so we have to count the number of months that the subsidiary was owned by the parent, and that becomes from January to June. So from 1st January to the 30th June, which happens to be 6 months, the subsidiary was owned by the parent. But from the beginning till 1st January, it wasn't so. So we're going to use 6 months to do our calculations. Now, it means that all those income and expense items that you see on the profit or loss, not all of them is for the group. Please take note that the parent will have ownership of only 6 months of the revenue and would also incur only 6 months of the expenses. And so whatever consolidation that we are going to do, we are going to consolidate. Remember that the parent is Moon, and we have bought shares in Stars. Now, Stars Limited's financial statement is what we are going to consolidate with that of the parent. But remember that when we are consolidating the financial statement of Stars, we are going to only apportion 6 months of the income and expenses to that of the parent. Please take note. We are not going to add everything. Only 6 months of that will belong. The previous 6 months will belong to the previous owners before we bought the ownership of the shares in the company. So this is something you should really understand. Right? Now, the question is, how do we know? Okay, how do we know that, for example, if the sales is 10,000, how do we know that all the 10,000 was earned in the first 6 months or in the last 6 months, or which portion of the 10,000 was earned within the 6 months of ownership? Because it could be that this 10,000, 8,000 of it was earned in the first 6 months when we had not bought shares in the company, and maybe only 2,000 was earned in the 6 months. We do not know. However, we are not told that information. And by default, once you are not told, there is an assumption that income is earned evenly over the year, then expenses accrue evenly over the year. When we say evenly, it means that we assume that every month we earn the same income to sum up to the annual sales, and the expenses are also accruing evenly over the year. We are even fortunate that in this question we have been told, if you go down, you see another requirement. We are told that assume income and expenses other than the intra-group items accrue evenly. So apart from intra-group items, all other income and expenses are supposed to accrue evenly. Therefore, we can easily apportion. So if we are owning it for 6 months, then we can say that if the sales revenue, for example, is 10,000, then we can say 10,000 times 6 over 12 will belong to the parent, and the other belongs to the previous owners. I'm sure this is very understandable. So we are going to go through this question again, and then we are going to solve it with the assumption that only half of the income and expenses belongs to the parent company, but the other half will not be consolidated because the acquisition was made in the middle of the year, and the consolidation is being made in the same year of acquisition. Because we could have bought it in 2024 or 2025, but the question could have asked us to consolidate for 2026. In that case, we would have owned it the whole year of 2026. Mid-year acquisition, and when you are consolidating for the very first year, that is where you do this kind of apportionment, because the acquisition was made in the middle of the year, and therefore revenue and expenses will also be apportioned for the number of months in which ownership of the subsidiary was held by the parent. So if it was acquired, let's say, after 4 months of the accounting year, then it means that the parent would have held ownership of the subsidiary for 8 months of the remaining year. So it would have been 8 over 12. That is what we would have used for the apportionment for the revenue and expense items, with the exception of intra-group trading and intra-group activities. All the others will be done that way. I'm sure this is very understandable. So I'm going to solve it with you. So let's look at the question again. Moon Limited operated as a single company, but in 2025 decided to expand its operations. Moon Limited acquired a 60% interest in Stars on 1st January 2025 for 2 million Ghana cedis. So we are going to solve, as we read, we'll be solving. One of the first workings I have told you have to do is a group structure. So I'm going to clean this and we'll start solving, indicating the group structure first. Working one, the group structure. Now, the group structure is like this because the 60% has been already given to you. So parent holds 60% of the subsidiary, and then non-controlling interest will definitely hold the rest of the 40%, giving us 100. So that is the first thing you show in your solution, the group structure. Parent holds 60% of the subsidiary, and then NCI will hold the remaining, which is 40%. That is the group structure. And then let's continue reading. The statement of comprehensive income of Moon Limited and Stars Limited for the years ended 30th June 2025 are as follows. So we have already gone through that, but I want to let you pay attention to something. You see that after administrative expenses, we have finance costs of 200 for Moon and 70 for Stars, and then also there is finance income of 50. Now, in the additional information, we are told that there was a loan, intra-group loan, okay, and we have told that we are going to apportion all expense and income with the exception of the intra-group items. But you take note of something. In the additional information, we are told that on acquisition date, Moon advanced a loan to Stars amounting to 800,000 at a preferential interest rate of 5%. The loan is due for payment in 2032. Now, what we are trying to say is that you see that finance expense and finance income in there, okay? It means that there is an interest on the loan. That is part of the finance expense of the subsidiary because it was the parent that sold to the subsidiary, or it was the parent that advanced loan to the subsidiary. Therefore, the subsidiary's interest expense will include the interest expense that is due to the parent, and the parent's finance income will include interest expense that is due from the subsidiary. And we know that these are intra-group activities that must cancel each other. So when we are consolidating, we will take note of that and I'll treat it that way. So let's skip and then go and read additional information again. And then we'll start working. Since acquisition, Moon purchased 320,000 Ghana cedis of goods from Stars. Of these, 60,000 Ghana cedi remained in inventories at the year end. So we have already spoken about intra-group activity and then unrealized profit. So in this case, when there is an intra-group sales, we are only interested in the fact that the intra-group sales must be reversed from both the revenue and the cost of sales. But we also pay attention that if there is any part of the goods that is left in inventory, like the 60,000 we have mentioned here, we'll check for any unrealized profit. That is when it was made, the sales was made at a markup or a margin. Now, that is if there was a profit element on the sales, which indeed there is. So 60,000 is remaining in inventory. Now, let's go and check the profit percentage, and then let's calculate the unrealized profit on the remaining inventories, and then we treat it as well. We know how to treat unrealized profits. Okay, so Stars makes a markup on cost of 20% under the transfer pricing agreement between the two companies. And so what we are trying to say is that there was a markup of 20% on the original sales. So if 60,000 is remaining in inventory, then we need to take out the unrealized profit from the financial statement. Now, take note that it was the parent that bought from the subsidiary. It was the parent that bought from the subsidiary. It was Moon Limited that bought from Stars Limited. So let's calculate the unrealized profits as workings, and then we'll deal with it in the financial statement. So number 2, unrealized profit on inventory. Unrealized profit on stock. They sold at 20% markup. Now, it means that the 60,000 that is remaining already has a profit element of 20% on it. So we cannot calculate only 20%. We have to include that in the denominator like I've explained to you already. So it's going to be 20% plus 100, 20 over 100 plus 20 over 100 plus 20. So it's going to be 20 over 120 because it is already inclusive. So you have to convert it to margin. Remember, I've taught you how to convert markup to margins. So 20 over 120 times the remainder of the stock, which is 60,000. Now, let me also bring your attention to something that in the financial statement, you realize that after the Ghana cedi sign, there are 3 zeros up. Okay, but in the additional information, they did not show those 3 zeros. So even though we have gotten 60,000 here, when we are recording in the consolidated financial statement, we're only going to record 60 because we are going to show 3 zeros up, which will take care of the final 3 zeros here. I just want you to understand that most of the time, the additional information, they give us the full figures. But in the financial statement itself, the 3 zeros are up. So you shouldn't be confused about that. All right, so 60,000. So when you multiply by 60,000, you are going to get 10,000. So it means that the unrealized profit that is on the remaining inventory is 10,000 Ghana cedis, which must be eliminated from the financial statement. This is not a profit that they have. You cannot sell to your own group member and then make a profit. We have spoken about these things long ago, so I'm sure you'll be fine with that. So when we get to the consolidated financial statement, we are going to treat this 10,000 as 10 because 3 zeros will already be up. So let's continue reading. As we read the additional information, then I solve it with you and then we'll continue from there. So we move to the next one. The fair value of the identifiable net assets of stars on purchase were 200,000 Ghana cedi greater than their book value. The difference relates to properties with remaining useful life of 20 years. Now, when Moon bought Stars Limited, it was discovered, this is fair value adjustment, which I have taught you already. Now, there was a value of 200,000. The net asset of Stars Limited was 200,000 Ghana cedi higher than their carrying amount. So that is a fair value adjustment. There is an increase in the net asset of the subsidiary on the day of acquisition. Now, we are also told that that particular item of asset that has an increase in the fair value has a remaining useful life of 20 years. So the extra 200,000 that has been added is an extra fair value, which will equally be depreciated. That is going to bring an additional depreciation to the financial statement. Let me read it again. The fair value of the identifiable net asset of stars on purchase were 200,000 Ghana cedis greater than their book value. The difference relates to properties with remaining useful life of 20 years. So what we are saying is that these 200,000, there has been an increase in the value of the properties. Now the properties already has been depreciated in a financial statement. But then, because there is an increase in the value, and this new value was on the date of acquisition, and it has a remaining useful life of 20 years. So we divide the new value by the 20 years to give us additional depreciation that should have been charged. That was not charged. So that is an additional depreciation on the additional fair value. However, it was done on the date of acquisition, and the date of acquisition was in the middle of the year, 6 months. Okay, so even though we are going to apply the depreciation as 200,000 over 20 years, we need to respect the timing of the cash flow by multiplying by 6 over 12 to indicate that it's accrued from the date of purchase to the end of the year, which is 6 months. So yes, the normal way of calculating for depreciation, but then it's going to be times 6 over 12 because we are told that all these expenses accrue evenly over the year. And we are respecting the 1 month ownership basis for depreciation. That is going to be our third workings. Additional depreciation on property. That is going to be 200,000 Ghana cedis over 20 years times 6 over 12. And that is going to give us 5,000 Ghana cedis. So yes, The additional depreciation is 5,000. Remember that 3 zeros will already be up. So I'm going to use the 5 for the financial statement because 3 zeros will be hanging in the air. So this is 5,000 Ghana cedis as additional depreciation. We are working all this. When I'm solving when I'm consolidating, you understand how all this will be treated. Now we continue from there. The next information says that on the acquisition date, Moon Limited advanced a loan to Stars Limited amounting to 800,000 Ghana cedi at a preferential interest rate of 5%. The loan is due for repayment in 2022. So on the date of acquisition, Moon actually gave a loan to Stars, the subsidiary, 800,000 Ghana cedis. Of course, we need to calculate the interest on the loan and then we'll cancel it off. We know that there is a finance income on the parent's income statement and there is a finance expense. So when we calculate this percentage on the loan, we are going to get the interest that will cancel out from both, which is an intra-group activity. Okay, so let's calculate the interest. So working number 4, interest on loan, which is going to be 5% times the 800,000. So the interest on loan is 5% times 800,000. Of course, times 6/12 because interest rate is paid per annum. But then the loan was advanced for only 6 months for the period from the date of acquisition. And so finally, we are going to have 20,000 Ghana cedi as the interest on loan. And so because 3 zeros will be up, I'm going to use 20 for the work that I'm going to do. I'm going to net off 20. If you go, let's go to the question and see something. Now you see that on the income statement, there is finance cost of 200 for Moon, 70 for Stars. So inside the 70 for Stars is this 20. This 20,000 is inside the 70,000 because there are 3 zeros up. So the 70 here, inside that, the 20 is already inclusive in the income finance expense for the subsidiary. So we are going to take out this 20 from the 70 and we'll be left with only 50. Then when we come to the finance income of 50 on the financial statement, as you can see, this 20 is inside that 50. So we are going to take the 20 out and we'll be left with only 30. So please take note. That is it for the interest on loan. The next additional information is about the extract from changes in equity, which we may just use to show the movement in reserves. So I'm going to hold on with that. But then the last sentence is also on the fact that we are only showing the capital, stated capital, which to me is not really relevant to what we are doing right now. So what we are going to do now is that having done the obvious ones that can be seen, let us also take note that we need to calculate the non-controlling interest share of the subsidiary's profit, because we will need that when we are preparing the consolidated statement of profit or loss. And so working 5 will be non-controlling interest share of the profit of the subsidiary. Non-controlling interest. So let me indicate 3 zeros up here. Now, we are looking at the non-controlling interest share in the subsidiary's profit. I keep hammering on the fact that NCI, or non-controlling interest, has no share in the company, the parent company's profit. They only have a share in the subsidiary's profit according to the percentage of control or ownership, which in this case is 40%. And so we need to look at the subsidiary's profit, make the necessary adjustment, and give them their share of the 40%, even before we prepare the consolidated statement of profit or loss. So it's very important. So let's look at that. So let's pick the profit for the year. So we are going to begin with the profit for the year for the subsidiary. Now, the profit for the year, according to this question, is 620,000. Now, let's take note of something. First thing you should take note of the fact is that income and expenses accrue evenly over the year. So even the profit we are going to write, only 6/12 will be applied for this week. Remember, this is midyear acquisition we are doing. Now, the second thing is that the interest on loan, which they have indicated 70 as interest expense, in their financial statement, we are told that 20 is intra-group. So 20 will be taken off. And once you are taking out 20 for the purpose of group, then the 20 is being added back to the profit. So if the profit here, according to the question, is 610, okay, so the profit for the year for the subsidiary is 610. But they had already deducted an interest on loan of 20. Okay, now this interest on loan is actually a period expense. For the sake of calculating the non-controlling interest, it must be deducted from the profit because the non-controlling interest is not part of the group. So I understand. But for the purpose of determining the profit for the year, actually, we need to add it back before we take it out again later as a period expense for the sake of the non-controlling interest. So I'm going to explain it to you. So what we are doing is that we are adding back the 20 to the profit because it has been subtracted in getting this profit. And we are saying that the true profit is that it shouldn't have been subtracted. So 610 plus 20 will give us 630. Then we multiply that by 6 over 12. And that is going to give us the actual profit that is to be shared for the parent and the subsidiary, which in this case becomes 315,000 Ghana cedis. Then after we have done this, then we can look at other adjustments like the depreciation adjustment and then the unrealized profit as well. Now, for the unrealized profit, the provision for unrealized profit on stock. Now, the unrealized profit is 10,000. Okay. Now, for the sake of the subsidiary, they thought that they were making some profit. Okay. But then, remember that it was the subsidiary that sold to the parent. And so non-controlling interest would have a share in that. But for the sake of calculating the profit to share, that particular amount cannot be called profit because it was to the group. And so we take the unrealized profit also out. And then the excess depreciation will also be taken out of the profit because depreciation has the effect of reducing the profit. So that is 5,000 will also be out. Okay. Now we want to know the profit to be given to the non-controlling interest. But what we are doing is that we are first adjusting the profit for the period before we pay a portion. Now, I said that for the sake of determining the profit to be adjusted, we need to add back the interest, okay, or the finance cost. Now, the interest on loan or the finance cost is entirely a post-acquisition period. It is not one of those expenses that happened before the acquisition. It's entirely a post-acquisition expense. So we added it back in determining the profit, but then we need to subtract it again as a full period cost in determining how much is left to be paid to the non-controlling interest. And so we also have to bring the interest on loan again here, and then we subtract it. So when we do so, we are going to have a net profit of 280. When we have a net profit of 280, and then we can share that and give a portion to NCI. So this is what I have done is that we want to look at the non-controlling interest share in the profit of the subsidiary, but we need to first of all adjust the profit. So the first thing we did was that we added back the finance cost, and then we used the time apportionment 6 over 12. So this is actually the profit that accrued in the 6 months period. But then we need to take out unrealized profit. We need to take out additional depreciation. And then because the unrealized profit, all of them are inside this profit. You are deceiving yourself that you have a profit that has not been realized. Okay, so you take it out. Additional depreciation will also reduce the profit. And then the interest on loan is also a post-acquisition period expense that must be reduced. But for the sake of calculating the profit that accrued, we needed to add that. So please take notes and learn. I know that may be confusing to you. I know. But just look at it and then try that with other questions. You'll be fine. Okay. Now that we have this as a profit, then we can now say the NCI share of the profit will be 40% times 280. So 40% here of the 280 gives them 112. So 112 Ghana cedis becomes the share of profit of the subsidiary. Then we can also find their share of the non-controlling. We can also find the NCI share of the comprehensive income. So their share of other comprehensive income. That is also going to be 40% of. Now let's go to the question and see. The other comprehensive income of the subsidiary was 180. So that will be 40% of 180 times 6/12. We need to use a time apportionment. The reason why we didn't use the 6/12 here is because we've already done that with the profit here. So there was no need. But here is something new that is coming. So we need to apportion with the time, mid-year acquisition. So that gives us 36 cedis. Okay. So then total comprehensive income of the non-controlling interest will be 148 Ghana cedis. So when we are done preparing the consolidated statement of income, we are going to show this as a share of profits of the non-controlling interest, and this becomes a share of the total comprehensive income, and I'm sure we'll be fine. So this is how to go about getting the value of the non-controlling interest. So having been able to do this, we can go on and then we'll begin the consolidation itself. When we are doing it, we realize that there is a need to do another workings, we'll come and do it. So let's begin the consolidation. So Moon Group Limited, consolidated statement of profit or loss for the year ended 30th June 2025. So let me indicate my currency sign here with 3 zeros, and then we begin. Now let's go to the question. Revenue. We are consolidating revenue. Remember that the intra-group sales itself was 320,000 Ghana cedis in the question. So we'll take it out in consolidating, and then we'll add back the unrealized profit to the cost of sales. So revenue. Now in consolidating revenue, the revenue of the parent was 22,800. Okay, plus the revenue of the subsidiary is 4,300. But remember that we will multiply by 6/12. Now, we are multiplying only the revenue of the subsidiary. So for almost all the figures of the subsidiary, it will be multiplied by 6/12. Because we are told that income and expenses accrue evenly over the year. So that is how it's going to be. So the revenue of the parent plus 6/12, the revenue of the subsidiary, minus the intra-group sales of 320. Then you close it. Remember that there was intra-group sales. If you go to additional information, since acquisition, Moon purchased 320,000 Ghana cedis of goods from Stars. So that is the intra-group sales. We need to take that out of the revenue. And then we have a final figure of 24,630. And then after the revenue, the next thing is the cost of sales. So cost of sales. That one too, we open up a bracket, that of the parent plus that of the subsidiary. Remember that of the subsidiary will still apply 6/12. Then minus the intra-group sales plus the unrealized profit plus the additional depreciation. So take note. So the cost of sales for parent was 13,600. And the subsidiary was 2,006. So plus 2,600 times 6/12. Then you close the bracket, minus 320 plus 10, which is the unrealized profit, plus 5, which is the additional depreciation. So that is how the cost of sales will look like. And the final answer will be 14,595. So that will be in brackets, and then the resultant figure becomes our gross profit for the group, which is 10,035. And then afterwards, we look at distribution costs. We just consolidate the two. So distribution costs for the parent is 2,900 plus that of the subsidiary, which is 500. But then we are going to make it 500 times 6/12. So almost every expense or income of the subsidiary will be time apportioned. And that is going to give us 3,150 in brackets. Then we proceed. Administrative expenses too, we do the same for that. So administrative expenses. That of the parent is giving us 1,800. So 1,800 plus a time apportionment of that of the subsidiary, which was 300. So 300 times 6/12. And that gives us 1,950, also in brackets. Then we continue. There is finance cost. Now, with the finance cost, this is what we are going to do. Remember that we are going to take the 20 out of that of the subsidiary. So finance cost for parent is 200. So 200 is there, plus that of the subsidiary was 70. But because we have to take out the 20 here as an intra-group cancellation, we'll be left with 50. And the 50, we still apply 6/12. So please take note. You could have equally written 70 minus 20 into bracket times 6/12. All right. So we multiply that of the subsidiary by 6/12. In the question, it was 70. I'll put 50 here because of the intra-group cancellation. And that is going to give us a finance cost of 225 for the group. And then we continue with finance income. Now, remember that for finance income, the subsidiary had no finance income. The only finance income here is 50 for the parent, right? And we are also told we need to cancel it out with the same intra-group loan interest of 20. So you can simply indicate 50 minus 20. And that is going to be 30 for the finance income. That is positive. So I leave it standing without a bracket. And then from there, we can sum up and get our profits before tax. So profit before tax for the group is 4,740 Ghana cedis with 3 zeros up. And then we continue. From there, we look at the income tax expense and we combine them. So income tax expense. The income tax expense of the parent is 1,300. That of the subsidiary will be split into 2. So it will be 220 there times 6/12. And that is going to give us 1,410 in bracket. So you realize that for that of the subsidiary, all the income and expenses are being time apportioned with the assumption that interest, expenses and income accrue evenly over the year. So that gives us 3,330 as our profit after tax or profit for the year. So profit for the year is 3,330 for the group. I'm sure this is understandable. Okay. Then we now add other comprehensive income. So other comprehensive income. For the parent, the comprehensive income is 1,600, but for the subsidiary, it is 180. So 180 times 6 over 12, as usual. And that gives us 1,690. So we have a total comprehensive income of 5,020. So now that we have gotten this, the next thing is to look at the attribution. We look at the net profit attributable to the NCI and the parent, and the comprehensive income attributable to both. And then we are done. Okay, so we'll start with the profit. So profit for the year attributable to the column. So to that of the parent and that of NCI. In fact, that of NCI is what we have worked there. I know a lot of people prefer to finish with the consolidation, then they will come and do this one before they bring it here. Okay, but I chose to do it first. So in that case, that of the NCI is what you are going to write first. That of the parent will only be the balancing figure, because we know that the total net profit, we had it to be 3,330. That one is sure from the consolidated. So you need to first of all write that of the NCI, which is 112. And once you have that, you take your calculator, punch and take 112 out of 330, and the balancing figure or the difference becomes that of the parent, which is going to be 3,218. So this is the profit attributable to the parent and profit for NCI. Then we can do the same for the total comprehensive income attributable to the parent and NCI now as well. We'll say total comprehensive income attributable to parents and NCI. NCI has already been worked at 148. So we have 148 for NCI. We already know the total comprehensive income as 5,020 from the consolidated statement of profit or loss. So if that of NCI is 148, the difference on the balancing figure will be for the parent, which is 4872. And so, ladies and gentlemen, this is how to go by the consolidated statement of profit or loss. Of course, we need to also look at the consolidated retained earnings. Okay, so I'm going to clean this space and I'm going to do that here. The consolidated retained earnings. We can even decide to look at the reserves. Okay, so let's look at the consolidated retained earnings as well. So we have consolidated retained earnings or income surplus assets or for the year ended 30th June 2025. So we'll begin with that is, we are looking at the consolidated retained earnings, okay, as well. So we know that already from our previous videos, the group income surplus. We always begin with that of the parent. So the balance brought forward for the parent. In the question, the additional information, we have it down there, is 12,750. So 12,750. And then we can add their share of the other comprehensive income. So the parent share of other comprehensive income is 4872. So share of other comprehensive income. So 4,872. So once we add that, then we need to pay dividend out and then we'll be fine. So dividend was actually paid from the question. From the question, you can see that there was a dividend payment of 900. Someone will ask, let me answer this. Why did I not add a share of the net profit, but added the share of the total comprehensive income? Look at the question carefully. When they give the extract of the changes in equity, the balance brought forward, they paid out dividend of 900, and there is a total comprehensive income of 4,650. So they are dealing with total comprehensive income. So I need to deal with their share of the comprehensive income, not of the profit. Now, the dividend payment was made as 900. So we take it out, and then the final answer becomes 16,722. So this becomes the closing balance, or the balance carried down for the consolidated retained earnings. Now, I can prove that to you right now by showing you the movement. It is usually the group reserve plus the movement in their share of the movement in the subsidiaries reserve. And so I can prove this figure to you in a different way using the reserve approach by showing you the parent company's reserve plus their share of the movement in the subsidiaries reserve. Okay, but that may not be so necessary right now. What is most important is that we have been able to solve this, and I'm sure our understanding has really been enhanced. Okay, so this is it, and this will bring us to the end of our lesson on consolidated statement of profit or loss standing alone. Now we are going to take just one question that combines the profit or loss and the financial position, and then we'll look at how to go about it. And then subsequently, we'll pick the associates and joint ventures. Then we are advancing in the consolidated series. Remember to subscribe to my channel if it is your first time. Share this video. Let others also have a benefit. And until we meet again for another video, it is bye for now. Thank you.